is Dr. Mark FABER, editor and publisher of the Gloom, Boom, and Doom Report. Mark, thank you so much for joining us today.
It's my pleasure. Thank you.
All right. Now, the first topic I'd like to discuss is the stock market. Now, around the world, we saw just a couple weeks ago, the stock markets sell off quite a bit. In the United States, the Dow right now is down over 1,500 points from its high. My question to you is, what is your perspective on this? Why do you see it happening? And do you see a sell-off continuing in the United States and around the world?
Yes, I think everybody would like to know whether after this correction, which is not very substantial in comparison to previous corrections, whether after this correction it's a buying opportunity, or whether investors should sell or reduce their positions on any rebound. My sense is that the world's economy is slowing down meaningfully. We have lots of announcements by economic sensitive companies, whether these are multinational German automobile manufacturers or industrial companies that serve numerous markets around the world, like Textron and so forth. The announcements have been guiding on the downside. And it's obvious that the Chinese economy is slowing down. And I'm an economist, but I also look at what is happening around me. I can say that there is a slowdown in economic activity everywhere I go to. So I'd say that corporate profits will likely disappoint at the time when valuations are very high and at the time when global liquidity is tightening. So my view would be, yes, maybe there will be a rebound on a very short-term basis. We're oversold, but we're nowhere near as oversold as we were in, say, February 2016. That was the last big correction from where the bull market continued to roar. But we are oversold on a short-term basis, and we can rebound somewhat. There's seasonal strength between now and early next year, but I doubt that the majority of shares will make new highs. Maybe a few shares will make new highs, but my sense is that the indices of most markets around the world, they've peaked out already.
Now, last time we had you on, you were talking about how you thought it was unlikely that a major crash was going to happen anytime soon, but more like a slow grinding down, in a sense, of the stock markets around the world. What is your perspective? A lot of people I'm talking about are saying that they're looking for a more than 50% crash sometime soon. It doesn't seem like that's what you're looking for right now.
Well, I would not rule out that a large number of stocks will drop by 50%. Don't forget, a large number of stocks have already dropped by 30-40%. So 50% is now not out of the ordinary. But I'd say this. I went through the 87 crash. We dropped by 21% in just one day. That is a crash. Or if you crash within 10 days by 20% or 15%, that is kind of a crash. I don't expect that right now. I think that central banks will come back in. and ease monetary conditions and so forth. So I don't see a collapse. But I think over the next 2 years, investors will not make any money in equities, as, by the way, most investors have not made any money over the last 12 months. Some stocks have gone up, but if you look at global markets, with the exception of the U.S. and maybe one or two other markets, all of them are in the red. So I think that the situation for investors is not very conducive towards large capital gains. I rather think that most investors who have a diversified portfolio will lose money. So the question is how much, and that will depend on what kind of stocks they own.
Now, moving our focus to this bond market, we've recently seen the 10-year Treasury yield at its highest point since 2011. What is your perspective on why bonds are moving or are in a downturn right now, and where do you see them heading in the near future?
Well, the Federal Reserve has been tightening monetary conditions and increasing interest rates since December 2015. And starting about a year ago, the Fed started to reduce its balance sheet. In other words, they didn't buy additional bonds, but they actually sold bonds, and as a result of that, they reduced the balance sheet. This combined with, let's say, some symptoms of inflation have led bond buyers to stay away. So in other words, the supply of bonds is very large because, as you know, under the Trump policies, we have essentially unlimited budget deficits, fiscal deficits, and we have reduced demand, which pushes up interest rates. I think that compared to equities, 10-year treasuries are now relatively attractive, but they're not absolutely attractive because the yield is not like 5-6%, but it's 3.2%.
Right, and when investors, start realizing this, how do you see the dynamics between the stock market and the bond market really playing out?
Well, to tell you the truth, nobody knows for sure. There were periods in the last 100 years when bond yields went up and stocks continued to rally. And there were periods in the last 100 years when bond yields went up, in other words, interest rates went up, and stock prices declined. Both has happened. So if you ask me today, well, what will happen to the bond market, what will happen to the stock market, we don't know for sure. We can make certain assumptions, but we don't know for sure because the markets are being manipulated by central banks.
And speaking of that, some concrete ways in which central banks are, affecting the stock market, obviously, or affecting markets in general. Obviously, the Fed's policy is to control interest rates, so that's a very obvious way there. But also, Japan and Switzerland have, been buying equities. What is your perspective if we see another crisis where there's a significant drop in the stock market? Do you think other central banks and even the Fed might step in to prop up the market by buying equities?
Well, that's a good question because basically to buy equities is not the mandate. But as you know, the Federal Reserve has a so-called plunge protection team. and to what extent it would be used in a further significant sell-off in equities, who knows? These are all things you and I, we don't know. We only can make certain assumptions. My assumption is that the Federal Reserve, and especially the Trump administration, does not want a stock market that collapses. So what the interventions will be, we don't know for sure. Maybe the Fed will not come in, but what can happen is that the Treasury Department would essentially buy equities. That is a possibility.
And what specifically do you think that would look like, the Treasury buying equities? How would that happen?
Well, basically, it's quite simple. The Treasury could essentially borrow money and use that money to buy equities. Now, if they borrow money, then obviously the deficit goes up, but then the Fed may ease monetary conditions, you understand? So indirectly, the Fed has, of course, an influence on essentially the government purchasing equities. But it may not happen, and it may happen. My sense is if the market here, the stock market, drops another 15%, in other words, we would be down by 20% peak to trough, the Federal Reserve will no longer increase rates, and it may very well start to lower rates once again.
You mentioned how the last thing the Trump administration wants is a falling stock market. And also, last time we had you on, you were talking about one of the last things the Trump administration wants is a strong dollar. Now, we had you back on in April. You said we might see a strong dollar in the short term. Ever since then, the dollar has just gotten stronger. So can you give us an update on this? And what do you see happening to the dollar going forward?
Yes, the dollar has been basically very strong. Will it continue? Who knows? Because that depends also on policies in Western Europe and in Japan. But for now, I agree the dollar has been strong. On fundamentals, personally, I do not think that the dollar should be strong. But there are all kinds of views. They say, well, the dollar is not a good currency, but the others are even worse. So these are things that are very difficult to predict. I personally think that the dollar may strengthen somewhat more, but eventually I think the dollar will weaken considerably as the Fed, given the economic weakness that is developing, and very clearly developing, that the Fed will no longer increase rates and may embark on quantitative easing sometimes towards the end of the year or early next year. And in that case, I think the U.S. dollar could become very weak.
Now, moving our focus to the last topic I'd like to discuss, precious metals. Last time we had you on, you were talking about how you're bullish on precious metals, especially silver. You see has a greater upside. We've seen precious metals stay pretty constant. They have just risen in the past couple weeks a bit. Do you think precious metals have bottomed? And also, are you still more bullish on silver?
Well, the thing is, precious metals this year in U.S. dollars are down 7%. Okay? So it's not exactly a strong performance, but they're still up compared to 1999 and compared to December 2015. So it hasn't been a disaster. Moreover, this year, most European and Asian markets are down more than 7% in dollar terms. So whoever says gold is horrible as an investment, it hasn't done well, but it's done better than the majority of foreign markets and the majority of commodities. So I think that the performance is not a disaster, but I think given what I just told you, that eventually the Fed will not increase rates much further and will eventually cut them, I think gold and silver are relatively attractive investment vehicles.
Definitely. And regarding gold versus silver, are you still seeing that silver has a greater potential upside?
Yes, in bull markets for precious metals, silver tends to shine, in other words, outperform gold. But as I said, we don't know exactly when this turn will come and when precious metals will take off. Because the dollar strength, precious metals have less use for investors for the time being. But the moment the dollar weakens, I think that lots of people will be interested in gold and silver and also platinum.
All right. Well, Mark Faber from the Gloom, Boom, and Doom Report, thank you so much for joining us today. Would you want to remind our viewers where they can find you and any last thoughts you had?
We have a website, gloomboomdoom.com, and there investors can subscribe to either a printed version of the GBD report, the Gloom, Boom, and Doom report, or what suits people most, or investors most, is the website report, which can be subscribed there directly.
All right. Once again, Dr. Mark Faber, thank you so much for your time.
Well, thank you very much for having me on your program.